For Chapter 16, I want to start out with a review on deferred tax liabilities and go over something that I did in class on the first day we did this chapter, but it's been a while, so I want to go over it again. Now, what we're doing here, what we're going to address is the fact that the accounting for GAAP is different from the accounting for tax purposes. So we have different methods of recognizing revenue. Certain expenses are expenses for GAAP under different rules than when they're expenses for tax purposes. And so that's going to cause us to have some differences in terms of the amount of income that we're reporting to the IRS versus the amount of income that we are reporting on for generally accepted accounting principles. So let's take a look at a problem. I'm going to start by illustrating this with a problem. Okay, so let's imagine an asset that costs $80,000, has no salvage value, and a 4-year useful life. The company that we're discussing has an annual income before depreciation of $100,000, and the income tax rate is 30%. Now, for tax purposes, or rather for GAAP, we're gonna depreciate this asset using straight line depreciation. And for tax purposes, we're going to use maker's depreciation, which you haven't taken a tax class yet. That stands for Modified Accelerating Cost Recovery System. And for our asset, that's going to be double declining balance depreciation. Okay, so let's take a look at how our book expense under straight line differs from our tax deduction for makers. Now, in the first year, for generally accepted accounting principles, you can see that for year one, we have income of $100,000, depreciation of $20,000, right? Straight line, $80,000 divided by 4 would be $20,000 a year, and that gives us net income of $80,000. Now, for tax purposes, we also have $100,000 before depreciation, but for double declining balance, we would have more depreciation. We'd have 40%, right? Because let's figure that out, that double declining balance. We take the straight line rate, 4 years, that'd be 25% a year, and we double it, that'd be 50% a year, 50% of whatever the remaining book value is. So the first year, we have an $80,000 asset, and that's also the book value. We take 50%, that's 40% depreciation, leaving us $60,000 in net income. And notice that in terms of our depreciation here, we have a $20,000 difference. Okay, our net income is $20,000 less for tax than it is for GAAP. All right, now let's look at the next year. Year two, because we're assuming every year the company has $100,000. So in the next year, depreciation for GAAP, $20,000 again. But for makers, let's see, we started out with 80, we took $40,000 depreciation. That leaves us with a tax book value, if you will, of $40,000. Half of $40,000 is $20,000, right? 25% times 2, so $20,000 in depreciation, give us net income of $80,000. And in year two, there's no difference. Then year three, same thing for book. We have $20,000 here for depreciation under straight line depreciation, another $80,000 in net income. And for tax purposes, double declining balance switches over to straight line under the tax rules. One straight line would be higher than what we would compute for double declining balance, so that would be $20,000 again. And that would completely depreciate the asset, right? 40,000 plus 20 plus 20, that'd be 80,000. Our net income, looking over here, is going to 100 minus 20 is 80. Again, we have no difference in the third year between book and tax expenses or tax income. And now for year four, again, we have $100,000 in income, $20,000 in depreciation over here on straight line, and we have $100,000 in for tax, but now we have no depreciation, right? Because we've already depreciated that entire $80,000, and so now our net income is the whole $100,000, and now that's different. Okay, but this time taxable income is greater, so we have a positive $20,000. And now look what's happened. Let's go forward. We look at the totals for both book and for tax. We have recognized $400,000. For depreciation in total, we've recognized $80,000. For net income, for tax and for books, we've recognized $320,000. And this difference that originated in the first year has reversed itself so there's zero at the end. So this whole issue between book expense and tax deduction for this depreciation is just a timing difference. And so what we're going to be doing now is we're going to be thinking of our differences always from the standpoint of GAAP. Okay, you want to imagine what we're doing. We're going to make some journal entries. We're going to imagine creating some assets here, and we're going to do that from the standpoint of GAAP. So as we talk about it, I'll keep reminding you, I want you to look at this from the standpoint of generally accepted accounting principles. Because the idea is that if in year one we have $80,000 of net income from a book expense, but we're only having $60,000 in tax, then, and this is what we're actually paying, right? This is the amount of tax that we'd actually pay to the IRS. So since this is going to turn itself around, right? So our net income that we're going to pay tax on over 4 years is the same as our net income that we're going to recognize for books, then you might think of this in terms of, okay, we have $80,000 in net income in the first year from a GAAP standpoint, but we're only paying on $60,000 worth of that income. But we know it's going to be the same in the end. So in a way, from the standpoint of GAAP, in year one, we owe tax on $20,000, okay? That's tax that we're going to pay later. In the end, we're going to pay tax on the same amount that we are making for generally accepted accounting purposes, but the when is that we have this $20,000 that we're not paying income on in year one because Makers is accelerated, we're taking more depreciation in year one, but then we're making up for it down here in year 4, okay? And so what we're going to call that, and I have it up here, this is going to be a deferred tax liability. So we see deferred tax liabilities, that's DTL, okay? Now, this is an income statement standpoint. Okay, we're looking at this in terms of the difference in depreciation expense. And so I hope everybody can see that from a generally accepted accounting principle standpoint, right? Tax is important to what we're talking about, but this is a financial accounting class. We are dealing with this from a book standpoint, from a GAAP standpoint. So you could look at this and say that because we're not paying tax on $20,000 of it this year, we have to make that up later. So we're not eliminating the tax liability on this $20,000. We're actually just postponing it to the 4th year. Okay? All right, just kind of keep that in mind. So for this $20,000 difference, we're going to record a deferred tax liability, not of $20,000. That $20,000 is a difference in income, okay? The deferred tax liability is 30% of $20,000, okay? By paying on $20,000 less income at 30%, that's $20,000 times 30%, we're going to record a deferred tax liability of $6,000. And then that deferred tax liability is effectively going to be paid off down here in year 4. Year 4, we're going to pay tax on $20,000 more income than from GAAP. And so then that deferred tax liability, if we had a T account for it, we would increase it by $6,000 in year 1, and then we would decrease it by $6,000 in year 4, so that at the end of year 4, we're going to have a balance of 0. Okay, now that's looking at it from an income statement standpoint, and I start there because it's pretty easy to understand that way. And the book starts out that way, and every student starts looking at deferred tax liabilities by looking at it from the standpoint of the income statement. But in all truth, that's not really how we do it. It's just there's too many things to go on. You can imagine a real company to have hundreds and thousands of assets, and it would be just unbelievably difficult to schedule each one of these and how they're going to turn around. But looking at it this way helps us understand it. And the way we actually did it, when we do it when we go out there, and I went on these when I was at KPMG, that was the only time the tax people really got to go out on the audit. We look at it from a balance sheet standpoint, and I'm just going to do 1 year here, okay? And that 1 year, year 1, when we buy the asset, it has for GAAP, we'd say it has an $80,000 historical cost, and for tax purposes, we would say it has a tax book value of its original basis of $80,000, okay? And then we take our accumulated depreciation, right? And you can see that. You can see that up here, right? This $20,000 is going down to there, and this $40,000 is coming from here. Okay, so we have we take our, and then we look at our book value and our tax value, and sure enough, our book value and our adjusted basis, right? That's what we call tax book value, adjusted basis. They're different by how much? Well, conveniently, they're off, or they're different rather by, $20,000, and that's the same. And then of course we did that difference in their book values times 30%. Gives us the same $6,000 that we computed up there. All right. Now, and then if we think about it, well, in year 2, they're taking the same amount of depreciation, so the difference in book value isn't going to change. And in year 3, they're taking the same amount of depreciation, so the book value between tax and GAAP isn't going to change. But then in the 4th year, we're going to take more depreciation for book value than we are for tax, and so then by the time we get it all done, then the book value and the adjusted basis are going to be the same, right? It's going to be 80,000 minus 80,000 at the end of year 4, and that's going to be 0, and 80,000 minus 80,000 for tax, so it's going to be 0 at the end, and that's how the difference is going to be 0 between book value and adjusted basis, so that's how we'd get down to the 0. Okay, so I'm going to write that over here. Let's look at it this way. If I write over on the side our book value, then for GAAP, that's going to be at the end of year 1, it's going to be 60,000 and 40,000 and 20,000 and 0. And then over here for tax, our adjusted basis, right? Our tax book value is going to be 80 minus 40 is $40,000, and then minus another 20 is $20,000, and then minus another 20 at the end of year 3 is 0, and then at the end of year 4 it's 0. So let's look at the differences. Well, in the first year we have 60 minus 40, that's our $20,000 difference. Then at the end of year 2, we have 40 and 20. That's still a $20,000 difference, right? So our deferred tax liability stays the same. At the end of year 3, it's 20,000 to 0, still a $20,000 difference, times 30% gives us 6,000. So if we look at our, and then finally in year 4, it's 0 to 0, and then our deferred tax liability is 0. So let's take a look at this. I'm going to make a list. Our deferred tax liability, looking at up here, was 20,000, 20,000, 20,000, and then it went to 0, right? And I showed you that in the T account. But if I look down here in terms of book value, year 1, year 2, year 3, year 4. For year 1, we have a difference right over here of 20,000. Then for year 2, we still have a difference of 20,000. Year 3, we have a difference of 20,000. And year 4, we have a difference of 0. So our deferred tax liability, right, times 30% is going to be 6,000, 6,000, 6,000, and then 0. Okay, and that's what we did here. Goes down to 0 in year 4. Okay, so that we can look at it from a financial accounting standpoint, and we can look at it from a balance sheet standpoint. And truthfully, when we're doing a whole bunch of assets, it's a lot easier to look at this from a balance sheet standpoint. Now, I hope that helps. I did that in class, and I had a lot more board. It was probably easier for me to do that. If you have questions, you're going to have to, and you weren't there that day. If you were that day, this probably is jogging your memory, and if you weren't, you may have more questions, and I encourage you to contact me. Now, we have this $20,000 difference. So what? What does that do for us in terms of our journal entries, right? This is because, I mean, ultimately, that's a lot of what we're doing is journal entries. Well, let's look at deferred tax liabilities. The year 1 tax expense journal entry, or often it's called the tax provision. So we would be crediting deferred tax liability for $6,000. That's the $20,000 difference in the expenses, or in the book value, however you want to think of it, times 30%. Okay, that's a liability account. And then we have our, my mouse moved here, income tax payable. That would be the amount we actually have to pay to the IRS. Well, our taxable income was $60,000, right? So $20,000 was our difference. And then $60,000, this was our taxable income, right? So our taxable income times the tax rate of 30% gives us $18,000. And then, and this is always the case when we're doing this, it's going to seem stupid, or at least not stupid, but silly to even think of it this way when we're doing such a simple problem. But I'll tell you that as the problem gets harder, that's the only way to do it. Here, our income tax expense of $24,000, that's a plug. Okay, oops, come back here. Hey, that's a plug. Our income tax expense is the sum of our income tax payable. We can think of that as our current tax expense. Okay, that's our current. And then this $6,000, that is our deferred tax expense. And our total tax expense is the sum of our current, the amount we're going to actually pay, and our deferred, the amount we're going to pay in the future, because this is GAAP, right? This is accrual-based accounting. And under accrual accounting, we recognize an expense. We recognize this $24,000 when it's actually incurred, not when we pay it. We're incurring, this is the amount we have to pay to the government today, and this is the amount we're going to have to pay to them in the future. Again, it only makes sense if you realize that we're thinking of it from the standpoint of financial accounting. And we're saying we're going to have to pay it later from the standpoint of I had $80,000 in income from a GAAP standpoint, but I only paid tax on 60,000 of it. Therefore, this 20, I'm just ending up paying that later. So that's a deferred tax liability, but we're going to recognize the tax expense of this whole 80,000 in the first year, and that's what we've done, right? $80,000 times, if you want to think about it, and this won't always work, but it won't always seem like it'll work, but isn't this $24,000 really our isn't that $24,000? Couldn't we also compute that by going $80,000 in GAAP income times our 30% tax rate? And that's our tax rate. And that gives us the $24,000. So, oops, one extra zero. So that's what we're doing, is we are recognizing this tax expense in the year we incur it, which is in the year we have the GAAP income, and then when we eventually pay that tax in the fourth year, we won't re-recognize the expense. We'll just pay off this deferred tax liability. Okay. All right. So that's my review there, and I want to go over another example just to kind of drive this home. This is exercise. If you look into your text, this is exercise 16.3 in the book. Symphony Services acquires an asset for $90 million in year one. The asset is depreciated for financial reporting purposes over 4 years on a straight line basis, no residual value. For tax purpose, the asset's cost is depreciated by makers. The enacted tax rate is 30%, counts for pre-tax income, depreciation, and taxable income for years 1, 2, 3, and 4 as follows. Now, this is how your book likes to put it, excuse me, and it's just a little different, but what they're doing is we're taking our pre-tax income, they are adding back the depreciation on the income statement, okay? So that's what's here. They're adding back depreciation under GAAP, and then they're subtracting this depreciation, which is makers. All right, and then they're coming up with taxable income. So because our pre-tax, the previous problem, I said, well, here's the income without depreciation. But of course, if we were actually going out there in a company, that's not realistic. We end up on our balance, or our income statement is pre-tax accounting income. There's no line on there for income before depreciation. So we have to back out the depreciation as an expense by adding it back, and then we subtract the depreciation of the tax return to get to our taxable income here for this problem. Now, for December 31st of each year, determine the temporary book-to-tax differences for the depreciable asset and the balance to be reported in the deferred tax liability account. Okay, so let's take a look. Now, hopefully you're thinking to yourself already that whatever that difference is that we're going to figure out is related to the differences between these two numbers in each year. Okay, that is what's driving the amount of our deferred tax liability. Okay, now, so let's work through this. Okay, we're going to look at our depreciable asset, its accounting book value. At the beginning, when we first buy it, right, it was $90 million, and our tax basis is also $90 million. The amount of depreciation we're taking for GAAP is $22.5 million, and for tax is $27 million. All right, see where these numbers are? We're pulling those off of. And so at the end of year one, that leaves us with a temporary difference of $4.5 million, okay, between the amount of depreciation, giving us a book value, accounting book value of $67.5 million for GAAP, and a difference of $63 million tax basis, right? Cost minus accumulated depreciation. And our difference between our book value and our tax book value is also $4.5 million. So you see we can come at that from either direction. Now we look at with tax rate's 30%, so our deferred tax liability at the end of year one is $1.35 million. Then for year two, again, for accounting, it's straight line, so we're taking $22.5 million again, and our tax basis is 36. Our tax depreciation is $36 million. Now at the end of year two, our deferred tax liability, or rather our temporary difference, right, it's going to turn around in the future, is going to be $13.5 million. Looking at our GAAP book value and our tax book value, now we have a total difference of $18 million. And you say, oh, hey, they matched over here, but they don't match over here. That's okay, because if you look at it, what we've done is from a book standpoint, we have a total of $4.5 million. Looking at it from a balance sheet standpoint. At the end of year two, we have a total of $18 million. Again, looking at it from a balance sheet standpoint, that's the sum of the difference in year one of $4.5 million plus the difference in year two, $13.5. So that's $18 million in total. Now we would multiply that by 30%, and we'd come up with a total deferred tax liability at the end of year two now of $5.4 million. These, the 4.5 and the 13.5, these are called originating differences because each of these increased the deferred tax liability. But then at some point, the amount of depreciation switches, in the sense of here in year one and year two, we're taking more depreciation for tax purposes than we are for book, but it switches around in year three and four. Now we're taking more depreciation for GAAP than we are for tax. Okay, and we call that the differences are reversing. So now for year three, we take, we have a basis at the beginning of the year of $45 million. We take another $22.5 million there, and we take another $17 million for depreciation for tax. Now, our difference in year three is $5.5 million, but notice it's $5.5 million negative. Okay, we had increases in deferred tax liability in year one and two. Now we're reversing. We're getting rid of it. $5.5 million year three. Giving us a book value for year three of $22.5 million, a tax basis in year three of $10 million, and a difference now of $12.5 million, right? We had 18, we got rid of 5.5, right? We used up some of that liability. Now we have 12.5 left, and then at the end of year four, we use up the remaining 12.5 so that our difference in bases is now 0 and our deferred tax liability is 0. So our deferred tax, these were the temporary differences. That's the amount of difference in depreciation expense. But remember, a deduction on a tax return is whatever that deduction is times 30% is the value, right? Or times the tax rate is the value. So we're taking the total difference in bases or the total difference in expense, multiplying it by 30% and giving us a deferred tax liability. This is what it would be on the balance sheet at the end of every year. It'd be 1.35 plus another, what would the difference be there? 4.05, and that would be, the difference here would be the 13.5 million times 30% would be the 4.05 million, and then we're using up 3.75 of it, and then we're using up the rest. Okay, so we could look at and maybe you should try this on your own, make up a T account for this problem. So that's my review on deferred tax liability. I'll make a next video so they can be shorter for deferred tax assets and then valuation accounts, and then we'll finish up the chapter.